Hi, Steve Van Metre here, and welcome to your Monday night premiere, where we take about 15 minutes every Monday and Wednesday night trying to make sense of markets. Well, today they actually make sense, but not in the grand scheme of things, but in the quarter end scheme of things, it does make sense. And I've got some housekeeping stuff for you, and then we're going to take a look at some interesting stuff, how the hedge funds managers are positioned, look at why agricultural commodities are starting to take off, all things I've been telling you in the data today. We'll take a look at that in a minute. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation to buy or sell any security, financial product, instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed via that alone do not reflect the view of Atlas Financial Advisory Inc. or Steven Van Metre Financial. So why did the markets not surprise me today? I figured it was going to be a low volume kind of snooze day and markets would end up. Well, there's a simple reason why. It's the end of a quarter. Now, large money managers, mutual fund managers, professional money managers, anybody who reporting to a client, well, there's two things they want every quarter. One, they want to push the account up as high as they can. So what they will do is they will take cash or weak positions going into the final day. They'll unload them and overload into positions. So for example, you have stocks like Apple and Microsoft that are market leaders. So if someone's pulling up their statement, they go, oh, look, oh, good, I got more Apple and I got more Microsoft. Now, why would a money manager do it? To push the market up, to push their whole account value up. And that's not just to make the client happy, because at the end of a quarter is when typically a lot of financial advisors, a lot of money managers, a lot of firms do their billing. Well, it's better to bill on an up than a down. So what will happen is I'll push it up, and then you'll see over the next 2 or 3 days, you'll see selling going on as they free up that cash that they invested to push the accounts up to cover their fees. So that is something that happens pretty much every quarter. Now, it doesn't guarantee that at the end of every quarter that the market's going to go up, but it's not unusual in days like today where there's low volume. And what does it tell you? There weren't a lot of buyers, but more importantly, there weren't a lot of sellers. So that's what you saw. Now, from a housekeeping perspective, I mentioned I was going to rebalance the legacy portfolios early this week, which my expectation was tomorrow. Why am I thinking tomorrow? Well, there's one thing I'm really curious about, and I want to see the construction spending data, because we know the non-farm payroll report has a strong correlation to that. Now, this Friday's payroll report is likely going to have a lot of census jobs. And now how many I don't know, because I don't keep track of census hiring. But I still wanted to see that. And I thought, well, Tuesday is a good day. It's the first of the month, and it seemed like a good idea. And I was double checking the positions that we're going to swap and whatnot. And it occurred to me, I'm like, oh, I need to double check and make sure that dividend on that bond fund that I'm going to sell is paid on the first, which is not unusual for a treasury bond fund. You'll see a dividend's paid usually the first day or two of the month. And I thought, well, it ought to be right around what I wanted. Well, it turns out it's the 3rd, which would be Thursday. And looking at what the dividend is, it's not really something that I want to walk away from, because the ex-dividend date is Thursday. And what ex-dividend simply means is if you own something prior to the ex-dividend date, then you get the dividend. But if you sell it prior to the ex-dividend date, you don't get it. So the solution is wait until Thursday, unless something big happens that would say, hey, markets are blowing up and things are really ramping and we need to switch and jump on that position. But I doubt anything's going to happen, at least in the short term. So that will probably happen on Thursday, although the portfolio shield rebalance will happen tomorrow as it normally does. Now, the Fed did have liquidity problems again. There was $60-some billion of overnight repos. Everyone's really dismissing that. It's one of those things, well, it's like a leaky faucet, or in my case, a leaky drip system this weekend. It's only a problem until the thing really breaks and you go like, okay, I guess I've got to get down there and dig this thing up and fix it. If it's a little leak, well, it'll wait a week. Oh, it's shooting water across the driveway. All right, well, get up and go to the hardware store and start, fixing your sprinklers, Steve. So that's kind of what people view the repo thing as. It is a problem. I also found out, I didn't know this, some of those things that you wish you didn't know until you find out. There are 24 member banks that can get repo operations. That I knew. I didn't realize that half of them were non-U.S. banks. They're European and Japanese banks. I didn't want to know that because it's probably where the problem is. My guess is in Europe, and that doesn't make me overly comfortable, but we're well positioned for that. So let's take a look at some charts here, and we'll get into some of the other stuff. All right, so we got the NASDAQ McClellan Summation Index liquidity, kind of peaked and is now rolling over. It's just impressive. Of course, maybe it was this drive into the end of the quarter that was just money managers pushing to get this up, even though we see liquidity conditions here look positive, but the market really didn't overly respond to that. Let's take a look at how the hedge funds are positioned, and then we'll look at the crop news. Pretty interesting. Okay, so hedge fund managers reduced their short positions on 10-year Treasury. Now, what I read today was that some people believe that this upshoot in yields had more to do with these quantitative computer programs. They trade based on a set of formulas, and they can trade daily. And they had brought yields down, and then maybe they got a little overextended and were driving yields up a little bit. But the direction, the people that kind of manage these boxes, and literally that's what they are, computer boxes, kind of say, well, we think that this short-term rise in yields based on them selling some of their profits is going to switch back to them buying again. But we see the hedge funds are backing off a little bit. Remember, you do not get bottoms in yields. So here until the hedge fund managers are long. So someone looks and says, oh no, we missed out. No, you didn't miss out. You missed out when it's way up here. Then when this green line's up here, then you miss out. Looking at the 30-year, so they backed off their 10-year shorts, not much, just a little bit, just a little switch there, and added to their 30-year shorts, which is interesting because this is where the opportunity is at when you know that the economy is deflating. They held steady on their oil longs. No big surprise there. They're fairly long. I mean, this is wildly long, so they're very long as it is. And S&P 500, they're fairly neutral, just a smidge long. And looking at gold, I think this is the highest long position now in 3 years I was reading. So look for gold to have a pretty nice unwind here and flush out all these speculative positions. That is really where you want to buy, because now you know all this here is smart money, buying, letting the dumb money and hedge fund managers do what they need to do. The dollar pushes higher, flushes people out of gold, and then now you've got what you call the base or the bottom resistance. You know roughly where the floor is. Tech stocks, they backed off their longs a little bit and added a little to their small cap shorts. Not a big deal there. But increased their dollar long. This is one of the few positions that I think the hedge fund managers are right in the short term, wrong in the long term. But you wouldn't be buying gold and long the dollar normally. Yes, there are times they can move up together. We've seen that here in the short term, but long term, that is not the typical relationship. But what really surprised me was they added to their volatility shorts. So they're not adding to their equity longs, but they're adding to their volatility shorts. That's usually a paired trade. You short volatility, you buy stocks. Buying stocks is shorting volatility. Buying index funds is shorting volatility. It's not directly, it's indirectly. So you think if you're going to short volatility, you would add to your equity longs, and they didn't. But what happens when volatility gets this short, when they get way down here, it usually surprises to the upside. And then you get some selling opportunities in there if you own volatility, or if you don't own volatility, which you shouldn't. What you get the opportunity is to potentially buy stocks that are a little bit cheaper. Now let's take a look at the climate conditions, and then we'll jump over to Twitter. So you see the weather-wise, there's, at least during the day, not a lot of cold weather. It's we're seeing that cooling front kind of back off a little bit. The concern is this rain is not helping farmers. They really don't want this rain. I'll show you that here in a moment. Let's look at the 8 to 14 day. You see the warmer weather's coming back. The farmers are going to be happy about that, but there's still above average rain sitting in here, something that they really don't want. Now let's take a look over at Twitter. Still make sure you're with me. So here's guys, a farmer. Our last planted is barely past half milk line. Now, I believe that's corn related, and I don't know exactly what that means, but it doesn't sound good. First planted, maybe backlayered in 10 days if it was warmer. Forecast flood watch tonight for much of Nebraska again. So you can tell he's not thrilled about that. Soybean harvest, 7% completed, so slightly above the 5-year average. Spring wheat harvest, 90%, should be at 99. Let's see, below expectations. Winter wheat planting, that's doing right around expectations. Now he says this doesn't help corn. This guy's an analyst in the Midwest who deals with crop stuff, and he doesn't help corn farmers in the northern half Midwest sleep at night. So I don't know exactly what his abbreviation. Maturity. So he's saying, okay, corn is not mature in the northern half of the Midwest, the light shaded. So you can see crop progress very weak. So the corn is not expected to be good. Soybeans, he says, a little better off. Usually the way the harvest goes, it starts north. So you're going to see Canada all the way down. It says corn harvest as of Sunday was 11% completed versus expectations of 14. 5-year average is 19%. So you can see harvest is way behind. And then corn crop, 43% is mature versus a typical pace of 73%. Just 55% of the soybean crop is mature versus a normal pace of 76%. So all that translates to is crop conditions aren't as good as the market is pricing in. As I said, when there's a boatload of people that are short, nothing but upside when they look at when you look at what's going on. So it's not good for us, not good for American consumers, because the last stage of a recession usually ends when crop prices rise. You normally don't want a recession at the same time, and there's a very simple reason why. Governments can quote unquote print money to solve problems, right? Oh, you're missing a mortgage payment, we'll print money. I'm not saying the US government or the Fed can print money, but just theoretically, we can print money to do that. But you can't print money, you can't eat money to feed yourself and your family. It doesn't work. And that's why rising crop prices is such a problem, because when you get these solar minimums and crop prices shoot up, the one thing consumers can't adjust to is rising food prices when they're overly indebted and their incomes are stagnating, and maybe they're losing their jobs because there's a recession. There's nothing they can do. And that's why you do not want a recession during the middle of a solar minimum, because you get these crop shortages, as we're about to find out. And consumers will have to shift their spending. So the government's trying to get discretionary spend, keep the economies going. Oh, food prices went up. Forget discretionary spend. I gotta feed my family, and I gotta pay on all this debt that I racked up over the last 10 years. Let's take a look at the markets here. We've got a few minutes. Let's look at the ag. So you can see we're breaking right above this line here. So let's go ahead and duplicate and move this up. So this is a little area of resistance right in here. And it was, give or take early in the morning. And then as the reports came out, boop. So what we should see here is there's a heavy amount of shorting here. So this should not take a whole lot of good news to get this up. And we got the first cross of the 50-day moving average, positive sign. That's rallies obviously begin when it crosses a 50-day. But we'd like to see this get up into here, where it will most likely stagnate for a while unless the news is pretty bad. And then what you can easily get is one of these moves here where it kind of just goes and goes. And we can look back. I see there's some give backs along here, but you can see once you're in these uptrends, depending on crop conditions, and here's the last one. Here's the last solar minimum right here, went parabolic, and conditions now are worse than they were then. Let's look at bonds. This is the one we're going to symbol SHY. This is one that's going to go away. It just closed over its 50-day moving average. Hopefully it'll get a little push here. Again, ex-dividend is Thursday, so maybe there'll be some buyers coming in to capitalize on the dividend. We'll look to dump that and pick up the Z-ROS. So unless something that's driving bond prices down, which I don't anticipate, but if something comes along, otherwise we're targeting Thursday. Looking at the 20-plus year Treasury bond, you can see it's just kind of consolidating right in this range between the highs, all-time highs, and right here. And the 50-day moving average is acting as a nice level of support. So that's really good. And we can see in the yields, looking at 10-year Treasury yields, sitting right under the 50-day moving average. So that's nice. No major movements going on here. 30-year yields, again, nothing major going on. Probably one of the biggest losers today is gold mining stocks. And here you can see junior miners breaking out of support. Why is this support? Because there were buyers. Oh, buyers are disappearing. Buyers are going to turn into sellers. So anyways, we'll kind of wrap that up here, and we'll be back on Wednesday to take a look at whatever's going on. We should have some ISM data, construction spending. We'll do a preview of the non-farm payroll report, and whatever else is available, we'll look at. I'm Steve Van Metre. Thanks for watching. Bye now.